Now that we know what shape the supply curve takes, we can start asking ourselves how we might be able to use it to illustrate real-world situations or scenarios. We know how the quantity supply changes when only market prices change, and we can see this by just moving up or down the supply curve itself. This is referred to as a change in the quantity supplied when there is a change in the price level, and results in a movement along a supply curve, upwards or downwards, depending on the price change itself. But more than just a change in the price can affect supply. When certain market factors change, other than the market price, which influence supply, we need to show how supply might change for a given price level. Not just the quantity supplied, but supply as a whole. To do this, we shift the supply curve upwards or downwards depending on the source and magnitude of the impact affecting supply. So what are some of the factors other than the price which influence supply? The more well-known factors include changes in input prices, such as labor costs or the costs of intermediate inputs. Let's use this example to illustrate how and why the entire supply curve needs to shift. Let's say there is a shortage of labor willing to work in coal mines within a region because more attractive job opportunities have become available, for instance in the construction industry. To attract or keep enough labor working at the mines, the mining companies will need to offer higher wages, which means it has become more expensive to produce and therefore supply coal in the region. Because the coal mines do not control the market price or the global trading price of coal, they will have to decrease the amount of coal they supply in order to maintain profit margins. This means that for a given price level, let's say $15 per kilogram per day, the amount of coal supplied by the market will drop from 200 kilograms per day to 150 kilograms per day. This is because the market now faces higher production costs and can't supply profitably the 200 kilograms of coal every day that it did before the increase in wage costs. And without an increase in the market price of coal, the mining firms will not be able to make enough profits to pay everyone higher wages to increase production back to the 200 kilogram per day value. What we have just described here is very close to what happens in the real world when global trading prices for raw commodities such as oil or coal fall. To illustrate the impact caused by higher input costs, we shift the supply curve S backwards. Some people say upwards, until the $15 point matches to the 150 kilogram mark. The new supply curve, which now takes into account higher input costs, is called S'. We can now see how the impact of more expensive labor has caused the quantity supplied to fall for all price levels. But a change in the costs of production inputs is not the only factor that can shift supply. Other factors include expectations regarding future prices, the number of firms supplying goods, or even technological improvements. External factors can also cause supply to increase. For example, let's say that coal was found much closer to the surface than expected, which means that production costs in the region are much lower than expected. If the mining firms in the region do not control the market price of coal, then the best they can do is sell more coal to make more profit, because the cost of producing that coal is now much lower than expected. So now we will see a rightward shift in supply because the mining firms in the region can now supply more coal per day for every price level. This increase in supply, not quantity supplied, is shown by the supply curve S double dash. Remember, quantity supplied refers to the point on the supply curve, whereas supply refers to the entire supply curve shifting for all price levels.